Hello everyone, and a very warm welcome to our webinar this morning, Get to Know Pensions for Sage 50 Payroll. My name's Duncan, I'm your host and presenter, and we are joined today by my colleagues Calvin, Ollie and Paddy, who are all standing by in the background, ready to answer your questions. Let's now take a look at what we'll cover in the webinar. So we're going to begin with showing you how to set up and assign a pension scheme in Sage 50 Payroll. So we're going to take a good look at the pension scheme settings. We're going to look at how to configure your pay elements to be included in pension calculations. And then we're going to show you how to assign that scheme to your employees manually if you're not using our pensions module. We're then going to discuss briefly opting in and opting out of a pension scheme. So we'll explain how that works, and again, how to manually process an opt-in and an opt-out request. But some of these things can be done with our pensions module. And if you'd like to know more about the pensions module, we are running another session this Thursday at 2 p.m. Where we'll run through the main features of the pensions module. So you can see how some of these processes can be automated, make your life that little bit easier if you use our pensions module. But for this session, we're going to finish with a section on calculations. So we're going to explain how pensions are calculated. We'll look at various combinations of settings, and we've got one calculation for you to have a go at the end as well, if you want to join in. And then we'll run through the further support that's available, and we should have some time for you to look through the questions and answers. So let's get things started by looking at setting up and then assigning a pension scheme. So it's your pension scheme settings that will control how a pension is calculated and deducted from your employee. So it is really important that you have the correct settings in place for your specific scheme. Now, there are some settings where we won't be able to tell you what the correct setting is for your particular scheme. And in these cases, if you're in any doubt, you should always check what setting should be applied with your individual pension provider. So we'll be looking at some of the common settings, and I'll be showing you the pension scheme that I've set up and how that all works. The other thing we're going to look at in terms of setup is pay element settings. So we're going to show you how to define which of your payments should be included in qualifying earnings and pensionable pay. And again, pensionable pay does depend on your pension scheme rules. And qualifying earnings does have a definition. So as defined by the pensions regulator, qualifying earnings includes anything that falls under the category of salary, wages, commission, bonuses, overtime, and the statutory payments listed there on the slide. So I want to give you a demo of all of these settings. So if I just bring the slides down, you'll see that I'm already logged into Sage 50 Payroll. And to access my pension schemes, I'm going to start from the company tasks here in the bottom left corner. And I'm then going to go into the pension schemes task here on the left-hand side. Now, if you're setting payroll up for the first time, you'll see that there are 10 schemes that can be used as templates. You could always add additional schemes if you need more than the 10. And I've already set up a couple of my schemes, and we're going to take a closer look here at scheme reference 1. So to view or edit the pension scheme settings, simply click Edit. In this case, it's telling me that it's in use by at least one employee. So I do already have this assigned. And you'll see here on the Details tab, the reference is assigned by the system. I've entered a description for the scheme to help me identify it. So I've just called it Nest Pension, with Nest being my provider. And then we have a drop down where I can choose the type of pension scheme that I'm using. So there are certain pension types that will automatically apply the relevant settings to your pension scheme. But if your type of scheme doesn't appear in this list, this is what you would use the other option for, and that allows you to apply the correct settings for your specific scheme. So I've got some of these that are no longer used. Contracted out schemes have now been abolished, but you do have scheme types such as GPP, which is a group personal pension, or a PPP, a personal pension plan. And if your scheme was one of those, if you chose that setting, it would automatically apply some of the appropriate settings for you. But in this case, I'm going to leave it as other. So I'm going to enter all the settings myself. And if you're unsure, again, check that with your pension provider, and if it's none of the ones that are in that list, you can choose other as well. The next box is a SCON. That's a scheme contracted out number, which is no longer relevant to pension schemes since contracting out has been abolished. But then we have a couple of check boxes which relate to automatic enrolment schemes. So the first one is to indicate that your pension scheme is a qualifying scheme for automatic enrolment. And that means that it meets the minimum requirements set out by the pensions regulator for use with an automatic enrolment workplace pension scheme. So if yours is a qualifying scheme, make sure you've got that box ticked. And then the second setting is for schemes that use qualifying earnings for pensionable pay. And this applies to a lot of the more recent pension schemes that have been set up since the introduction of auto-enrolment. So on the previous slide, we gave you the definition of qualifying earnings. Essentially, it's any payment that's subject to tax or national insurance, and it will calculate pension contributions on earnings between a lower and an upper threshold, which we're going to look at when we do the calculations. So that's a scheme which will have kind of a maximum contribution, if you like, or a maximum pensionable pay. Only other setting I want to point out here is the salary sacrifice scheme setting. So if your scheme is a salary sacrifice scheme, you would select this box. That will work slightly differently to a non-salary sacrifice scheme in that there won't be a direct employee contribution. There'll be a salary sacrifice amount instead, which will then be added to the employer contribution. But we're going to take a look at salary sacrifice schemes later on in the webinar. So I've got the details in place for my scheme. Let's now take a look at the contributions. So we're going to start on the employee tab. And you'll see that you can set a contribution as either a percentage or a fixed amount. Now, most commonly it will be a percentage, but there are circumstances where you may choose to set a pension contribution to a fixed amount, and that can be done on an individual employee basis where required as well. And I've got the default contribution for the employee set to 5% of the employee's qualifying earnings. And you'll see the settings here on the right-hand side to include statutory payments are automatically ticked. And the reason for that is I am using qualifying earnings for pensionable pay, and statutory payments do form part of the qualifying earnings. Now, again, that percentage could be amended at employee level, but we've set this as a default, and 5% would be the minimum employee contribution for this type of scheme if the employer was putting in their minimum of 3%. Now, one really important setting to point out on the employee tab, and this is in relation to the tax relief arrangement. So you'll need to make sure you've set up your scheme to either deduct before tax, if your scheme uses what's known as a net pay tax relief arrangement. And that would mean that the deduction is made before tax is calculated, or it might be deducted after tax, in which case you would not select this box. And that's known as a relief at source arrangement. And the way that an employee gets tax relief is that you deduct the pension after tax, but you would reduce the contribution by 20%. That's the basic rate of tax. And basic rate tax is then claimed back by the pension provider directly from HMRC. And the system will handle that adjustment to the contribution if it is deducted after tax, as it is in my case. So we've got the percentage. We've got the tax relief setting. In this case, it will be after tax. We can then set the default employer contribution. So again, I've selected a percentage and I've chosen 3%, which is the current minimum contribution for qualifying schemes for the employer. And then there's a provider tab where you can record provider details, such as the pension provider name, the reference your provider has given you, and if you want to record pension administrator details, you can do so in this section just here. So that is my pension scheme setup. The key settings are this one here, using qualifying earnings for pensionable pay. So check that out with your provider if you're not sure. If you don't have that box ticked, it will use specific payments to calculate the pensionable pay, and that will be taken from your pay element settings. And at this setting, deduct before tax. So you need to know whether you need to tick that or not, and your pension provider will give you clarification on that. So that is my pension scheme settings. And again, if you have more than one, you can set up more than one and you can assign the appropriate pension to your employees. Now, the other thing I want to look at in terms of settings is in relation to pay elements. So we're going to stay on the company tasks for this one. And I'm going to go into the pay elements option here on the left-hand side. Now in this demo, I've kept things really simple. I only have 3 payments. And if we edit the settings, we can control which of your payments are included in qualifying earnings and which payments should be classed as pensionable pay, which will be for any scheme that doesn't use qualifying earnings for pensionable pay and it uses specific elements instead. So I'll start by editing my basic payment. And the particular settings we're focused on here are in this section. This payment is subject to. So first of all, we've got it ticked for qualifying earnings. And as I say, pretty much all taxable and national insurance payments are also qualifying earnings. And we've decided for this one that if we do have schemes where specific payments are pensionable, we do want to include the basic pay as pensionable for the main contribution and also for additional voluntary contributions where they are used. Now, I've also got this element of pay set up to be included in salary sacrifice pensions. So this is fully pensionable and it's part of the qualifying earnings. Now, comparing this with another payment, so I've got a payment for bonus, which is included in qualifying earnings, so it falls under that definition of qualifying earnings. But if I had a scheme where it was only the basic pay that was pensionable, I would need to clear the boxes for pension main and pension ABC, and also in this case for salary sacrifice pensions. So it's still qualifying, but not involved in pension calculations for schemes that do not use qualifying earnings for pensionable pay. And I've applied the same settings for my overtime payment. So it's qualifying earnings, not flagged as pensionable. So that's just a look at my pay elements. And I just want to share a quick tip because you might have more than just the 3 payments. So if you want a quick way of checking your pay element settings, you can run the payment types report, which will give you all of the settings on one report. So to find that, just click the reports icon above your list of employees. Go to the company folder here on the left-hand side, and then find the one that is called payment types. And I'll just run this to preview on screen for you. And you'll see I've got my 3 payments, and we can see at a glance which one has been set up as pensionable. So it's just the basic pay in this case. All 3 of them are classed as qualifying earnings. And for salary sacrifice pensions, I just have the basic pay involved in the calculation. So a really handy report to check at a glance all of your pay element settings without having to go in and out of every individual payment. So that's a quick look at the pension scheme settings and also there the pay element settings. So we've highlighted the ones there involved in pension calculations. Next up, we'll need to get this assigned to the relevant employees. So if it's an auto-enrollment scheme, employees will need to be assigned to the scheme if they meet certain criteria. So you would do what's known as an assessment to see whether an employee meets the qualifying criteria, and if they do, they need to be put into a pension scheme or have been previously put in a pension scheme and since opt out. So there are 3 categories of workers when it comes to auto-enrollment. There's the eligible job holders, and those are the ones that need to go into a pension scheme. There's non-eligible job holders and entitled workers who don't get automatically enrolled, but those categories of workers do have the right to join a pension scheme or opt in if they want to. And within your legislation settings, you'll see an automatic enrolment section, which will confirm the current earnings trigger for auto-enrollment. So to be auto-enrolled, to be eligible, an employee would be between 22 and state pension age, and they'll be earning above the earnings trigger for their pay frequency, which is based on £10,000 per year. So where that applies, they need to be put into a scheme. If you use our pensions module, it'll do all of this assessment for you, and it will assign the scheme where a scheme needs to be assigned. If you don't use our pensions module, this is something you'll need to do manually. So I'm going to show you in the demo where you can assign a pension scheme to an employee that needs to be put into the pension if you're not using our pensions module. So let's have a quick look at that now. So to find that legislation from your company tasks, you can go into legislation and you can always check the automatic enrolment triggers and also the lower and upper threshold of qualifying earnings. So I'm running a monthly payroll, so my earnings trigger will be £833 per month. And you can see you're eligible, age between 22 and state pension age. Now, I do have an employee who has recently increased the number of hours they work. And due to this, they have now hit the criteria to be eligible. So it's employee 7 here. I'm just going to take you into the employee record. So we can see they're the right age. They're between 22 and state pension age. I give them a salary payment, and I've recently increased that to just under 20,000 a year, working 28 hours a week. And it means that per month, they are now above the earnings trigger. And that's the first time it's happened. If we look at their history, previously, they were just under the trigger of £833 per month. They've doubled their hours since then, so they now need to be put in. Now, because I'm not using the pensions module today, I'm going to assign the pension scheme manually. So actually to do this, I'm going to go back into the employee record. I'm going to click on the pensions tab. I'm going to come down to manage schemes. And from here, we can add the pension in. So when I click on to add, it asks me to choose the scheme from the drop down. So I'm going to put them into my Nest pension. It's going to set the join scheme and active membership date. So this can be amended where required. And it's also going to show the default contributions from the scheme, which could be amended in this area if for any reason we needed to do that. So I'm just going to stick with all the default contributions here, 5% for employee, 3% for employer. Happy with the join scheme date and the active membership date. So I'm just going to click OK. I'm going to close out of this screen, and they are now in the pension scheme. So what will happen now when I come to run my payroll, if I go into the enter payment screen, you'll see that their earnings have increased since I increased their salary. And if I click onto the summary tab, so this is where you can view the pension contributions, you'll see the employee contribution in with the deductions. So I've got £44.72 being contributed by the employee. And to view the employer's contribution, just click that employer's button. You can see that one is coming in at £33.54. So that information will also appear on payslips, as I'm sure you're aware, and payment summary reports and various pension reports as well. So that is how you would assign a scheme manually. And we'll take a look at leaving a scheme in the next section of the webinar. So we did the manual process today. If you're coming along on Thursday, you'll see how the pension assessment does all of this automatically. So when you use the pensions module, the key thing to understand with the pensions module is that you very rarely will assign a scheme manually. It's all done automatically, joining or leaving a scheme. And you can come along and see more on Thursday afternoon, where you'll see things like our pension assessment option, which will do the assessment and assign the scheme for you. Back to today's session though. Next thing we're going to take a look at is opting in and opting out of a pension scheme. So these are terms that are related to automatic enrolment, the workplace pensions law. Let's start with opting in. So for an employee that doesn't fall into the eligible category, so they're either non-eligible because they're too young or too old, or perhaps they're earning slightly below the earnings trigger, they would fall into that non-eligible category, or entitled. So if they're earning below the lower level of qualifying earnings, they still have the right under the workplace pension law to opt in to a pension scheme. Now, if they are classed as a non-eligible job holder and they opt in, they do need to go into a qualifying scheme where an employer must make a contribution. For an entitled worker, so those that earn below the lower level of qualifying earnings, they don't have to go into a qualifying scheme. So effectively, the employer can choose whether or not to contribute to that worker's pension. Opting out is kind of the opposite. So for an employee who has been automatically enrolled, they can choose to opt out of that pension scheme. They don't have to stay in it. And if they do it within a month of their active membership, they are entitled to a refund of any contributions that they've made. Or if they opt out after a month from when they joined, they can still leave the scheme, but whether or not they get a refund would be down to the pension scheme rules. Now, with an opt-out request, it must be made via the pension provider. So when you're opting in, they'll just come to you. They'll ask the employer, can I be put into the workplace pension scheme? If they're opting out, they do need to follow the official process from the pension provider, who will then inform you that the employee has opted out, or the employee might bring the official form to you from the provider with the opt-out details. So when that happens, you need to arrange for them to leave the pension scheme. So we're going to show you how to do that in Sage, and also, where applicable, process a refund. So again, we're going to concentrate on the manual process for this one. So I'm just going to bring the slides down, and we will first look at opting in an employee. So the employee that has written to us asking to be opted in is employee 10. And if I take a quick look in the employee record, looking at their age, they're only 20 years of age. So they don't meet the criteria to be automatically enrolled. In this case, they are too young. But looking at their history, they're earning plenty to hit the wage threshold, that earnings trigger, which is $833 per month. So they've written to us asking to be opted in, and to process this manually, very similar to what we did before, you go to the pension schemes, click onto manage schemes. You can then add the pension scheme in, and you can choose the scheme that they're going to join. So again, you would set the join scheme date and active membership date. And with an opt-in request, usually takes effect from the next pay reference period. So I might actually set this in the future to the start of the next tax month, for example. And then when the next period comes about, they will start to make contributions into this scheme. So again, you can amend the contributions if required and if allowed by the pension scheme. And then that is now in place, and that contribution will be taken with effect from the next pay reference period. So that's an opt-in. And then you would write to the employee just confirming that they've gone into the pension. Opting out or leaving a scheme, if the employee decides that it's no longer suitable for them, can be processed manually if you don't have the pensions module. So I'm just going to go back to employee 7, and let's imagine that they've decided they don't want to be in the pension scheme. They've contacted the provider and they've opted out. So what we would need to do in terms of their payroll record is come back to the pensions tab, go into manage schemes, you can edit the scheme, and you can enter a left scheme date. So maybe they've done this, say, first week of February. I've done it within a month of being enrolled. So if we'd taken a contribution, we would need to arrange a refund of that contribution. But once a scheme date has been entered, that will stop the contribution from that date onwards. And there is a section, if you're not using our pensions module, to manually record opt-out details. So we can pop the same details in here for your record keeping. So that's leaving a pension scheme. And in this case, if there is a refund to be made, I would need to create a payment, and we would pay that back to the employee. And that pay element will need to have the same settings as the way that the pension was originally deducted. So in our case, it was after tax. So we would refund it after tax as well. So that's opting in and opting out manually. There is options to do this in the pensions module. So again, a bit of a sneak preview of Thursday's session. You can handle all of that, plus the refund via the pension assessment option. But for today's webinar, we are going to move on to our last section, and we're going to take a closer look at pension calculations. So earlier in the webinar, we looked at the key settings involved in setting up your pension scheme. So as a reminder, the two key settings that I pointed out were using qualifying earnings for pensionable pay. So that's a reference to all earnings between the lower and upper threshold. And if you've ticked the box in your pension scheme settings, it will use qualifying earnings to work out the pensionable pay. And the other setting is for the tax relief. So is it deducted before or after tax? And in my example, we had a scheme deducted after tax, so that box was not ticked. But we'll discuss the effect of having that box ticked or not when we go through these calculations. So in reference to qualifying earnings, we saw this in the legislation settings earlier. There is a lower and upper threshold, and there's one of these for each of the different pay frequencies based on the annual amounts. So if you're doing a monthly payroll like I am, the lower threshold is £520 per month. The upper threshold, 4189. So it's the qualifying earnings between those amounts that would form the pensionable pay. So here are some examples. So this is one for the maths fans out there. First example, we have a pension scheme that doesn't use qualifying earnings and is deducted before tax. We've set it up with an employee contribution of 5% and employer contribution of 3%. And the employee's gross pay, and we're going to assume that's also the pensionable pay in this example, is £2,000. So for this one, it's a pretty straightforward calculation. So your £2,000 is your pensionable earnings. 5% of that amount is the employee contribution. So to get 5%, I'm just multiplying by 0.05, and that gives us £100 as being the employee's contribution. And because it's before tax, that full amount is deducted before tax will be calculated. Employer contribution, in this case, 3% of 2,000, and that comes to your £60. So altogether, £160 is going into the pension pot, and the tax relief has already been given because that £100 their contribution was deducted before tax. So let's just switch it up to our next example. So in the next example, we'll have a pension that does use qualifying earnings, but is deducted before tax. And we've used the same contribution amount, so 5% for employee, 3% for employer, and the same gross pay figure, so £2,000 in total. But for this one, the pensionable earnings are the qualifying earnings. So it's only those earnings that fall between the lower and upper threshold. So for this one, you can see we've taken our gross pay of £2,000 and we've deducted the monthly lower threshold of 520, leaving us £1,480. We've then worked out the percentages. So the employee contribution is 5% of that amount, which is £74. And the employer contribution in this case is 3% of the 1480, which is £44.40. So that's the extra step when you're using qualifying earnings, is to adjust for the lower and upper thresholds. Slightly different example for a pension using qualifying earnings. So we've still got this one deducted before tax, with the same contribution amounts, 5% employee, 3% employer, but they've had a good month. They've got gross pay of £8,000 in total this month. And because that amount is higher than the upper threshold of qualifying earnings, the amounts in excess of that upper threshold would not be classed as pensionable pay. So in effect, they've hit the kind of limit of pensionable earnings for a scheme that uses qualifying earnings. So for this one, we take the upper threshold and deduct the lower threshold, and that leaves you with 3,669. That is the pensionable earnings. And then we're applying the same percentages. It's before tax, so we don't need to make any adjustment to the employee contribution. So we take 5% of the pensionable pay to get the employee contribution, and 3% of the pensionable pay in this example is the employer's. So I've got a couple more of these for you. And remember, you can download these handouts so you can get the breakdown of these calculations yourself as well. So the next one, and this is the same setting that we saw in the demo. So it's a pension that uses qualifying earnings, but this one is deducted after tax. The employee contribution is 5% and the employer is 3. And we've gone with the same gross pay figure of £2,000. So first of all, we work out the pensionable earnings by deducting the lower threshold of qualifying earnings. So £1,480 is the pensionable pay in this case. We work out the employee's percentage. So 5% of that amount is £74. But because this one is deducted after tax, you need to make an adjustment to that contribution by deducting the basic rate of tax, so deducting 20% of that amount to leave the amount deducted from the employee. So the way that I would do this on a calculator, so we've got our 2,000 minus the 520, that's the pensionable pay. We've got our 5%, which is £74. To take off the 20%, to adjust it by 20%, I'm just going to multiply by 0.8. And that leaves you with the £59.20, which is the amount that will be deducted from the employee. Now, the tax relief will still be claimed, but it will be claimed by the pension provider directly from HMRC. So the amount deducted will go into the pension pot. The employer contribution, the 3%, will go into the pot, and then the provider will claim back the tax relief, and that will also go into the employee's pension with the provider. So if it's after tax, you do that adjustment to the employee contribution, making it net of basic rate tax. And I think this is the last example I'm going to give you, and this one is a salary sacrifice scheme. So we may have had questions on this, so I'm going to show you some of this in the demo. So for this calculation, we have a pension scheme that doesn't use qualifying earnings. So we've defined what pay elements are pensionable, but this one is a salary sacrifice scheme. So the employee's contribution, the amount they're sacrificing, will be 5% of their gross pay, and the employer contribution is 3%. And again, we're going to process a gross pay amount of £2,000. So in this case, the full £2,000 is pensionable earnings because it's not using qualifying earnings. And the amount sacrificed by the employee is 5% of that, which is a nice easy £100. The employer's contribution is 3% of 2,000, that's your £60. But officially, when this is paid over to the pension provider, the employer contribution would include both the salary sacrifice amount as well as the employer's own contribution. So what we get in this case is a £160 employer contribution and officially no employee contribution because that was a salary sacrifice instead. And I just want to show you how that works in the program. So if I just go back to my pension scheme settings, I do have a salary sacrifice pension set up. So the difference here is I've ticked the box to make it a salary sacrifice scheme. It's not using qualifying earnings. We've got a 5% sacrifice. We've got a 3% contribution. I've already got it assigned to one of my employees. So if I go into the enter payment screen, we've got their £2,000 salary, and we can see there's a salary sacrifice of £100. So there's no employee contribution, it's a salary sacrifice instead. And the employer contribution is the combined amount of the salary sacrifice and the employer contribution, so £160 altogether. So just something to watch out for if you do have a salary sacrifice scheme. You won't see the employee contribution, it'll all be included in the total. So that's the last one that I'm going to go through, but we do have a little bit of audience participation if you do want to have a go yourself. So we've put together relatively simple calculation, I hope. So this is for a pension scheme that uses qualifying earnings, where the amount is deducted after tax from the employee. Employee's contribution is 5% and the employer's is 3%. Employee is paid monthly, and we've put the thresholds on the screenshot there for you, just to help you out. And the employee's gross pay this month is £1,500. So I'm going to give you a couple of minutes to do this calculation. So we want to know the employee and the employer contribution based on those settings. So it uses qualifying earnings deducted after tax. Gross pay is a total of £1,500. And if you want to tell us what you got, just in the chat. Once we've had a few of those through, we'll have a look and see whether you were right. So just going to give you a couple of minutes there to have a go at that question. Okay, starting to see some answers coming through. We've got some correct answers, quite a few correct answers. A few of you have got it half right. So while we're just seeing some more of those come through, I'm going to run you through this calculation. So this is your answer anyway. So we have an employee contribution of £39.20 and employer contribution of £29.40. So most of you, pretty much all the answers I've seen have got the employer contribution right. So that was your 1,500 minus the lower threshold. So pensionable pay is 980 and 3% of that is your £29.40. That one's nice and straightforward. The employee's contribution is the one that's tripped a few of you up. So we start with the same pensionable pay, £980. We do our 5%, which is your £49. But because this one is deducted after tax, we need to adjust that by the basic rate of tax. And payroll does this for you, by the way. This is just for doing this calculation. So if I multiply by 0.8, it's your £39.20 that would actually come off of the employee's pay after tax. And that tax relief amount still ends up in the pension pot. So a total of 49 would go into the pot, but only £39.20 has been deducted from the employee. So well done for those that had a go, and well done for those that got the answer right. And that, I think, is the last one for you. So we are going to stick around. We've got a few minutes left of the scheduled time, and we're going to try and get through a few more questions in the Q&A section. So do keep an eye out for that if you'd like to see some more questions and answers. If you do think of something after you leave the webinar today, I just want to let you know about some of the further support that we have available for you guys. So we have an online help centre available 24/7 at sage.co.uk/help. And you can conveniently access this from within Sage Payroll by clicking on any help icon that you will see within the programme. If you follow the links to Sage 50 Payroll, you'll find all of our support guides. So we have a section dedicated to workplace pensions. You can also search our knowledge base. You can see other webinars that are available. So there is a webinars link at the top of the page there. And you can also find all the contact details for our support team as well. As well as the Help Centre, we have Sage University at sageu.com. So as a Sage member, this is completely free of charge for you to use. Just create your profile at www.sageu.com. And then once you're there, just follow the links for Sage 50 Payroll. So we have e-learning courses that you can dip in and out of at a time to suit you. You can do the online certification, pass our exams and get your certificate. And we also have a number of bite-sized learning courses on shorter topics just to help you increase your payroll knowledge. So as I say, we are still working through questions. If there are any questions and answers you want to keep hold of, you will need to copy and paste them into another document. I can see it has been quite busy on the questions. So hopefully we've got through a good amount of them. As I say, we'll spend a few more minutes doing that now before we wrap things up. So I'm going to go on to mute to help out with that just shortly. Just to let you know, there will be a recording of this session attached to your follow-up email, so you'll be able to follow the link to watch the recording. And that email is sent later today, usually within a couple of hours of the webinar finishing. And when you leave us today, when you click that exit button, you'll be presented with a post-webinar survey. And I'd really appreciate you spending just a moment to tell us what you thought of today's session. Remember, we've got pensions module coming up on Thursday as well. So there is a link to that, also in the follow-up email where you can sign up. So I'm going to go on to mute just for a moment, and I will come back when we're going to close this down. So I'll speak to you soon. Hi everyone, and thank you so much for sending those questions through. We are just sending back the last answers, so hopefully we've been able to answer most of those, if not all of them. Some great questions coming through, so thank you once again for sending those. As you exit the webinar, either when you click the exit button or when we end it, you will be presented with a short exit survey. So just asking a favour, if you wouldn't mind just completing that survey to let us know what you thought of today's session. Also, please look out for your follow-up email arriving later today. It will include the link to our webinar hub where you can register for future webinars and watch previous recordings of our sessions. So as we are now 5 minutes over the time allocated, we are going to close that down. So just finally, thanks once again for everyone that's attended and for those that have helped out with the questions. Enjoy the rest of your week. Hopefully see you on the pensions module webinar on Thursday if you've signed up. If not, I'm sure on another session very soon. So from myself and the team, thank you and goodbye.